Something snapped in the housing market this year, and it wasn't foreclosure numbers. It was the moment people realized the data only looks calm because the pressure is being absorbed somewhere else entirely. Now, somewhere, the headlines just haven't caught up to it yet. But if you've been staring at listings, wondering how some home prices keep rising while everything else in your financial life feels like it's getting tighter, you're not imagining that tension. You're feeling the early shape of something real forming underneath the surface. And it's the same tension millions of families are sitting with right now, quietly hoping the numbers start making sense again. And here's a contradiction people keep pulling in, right? Foreclosures are rising for the 8th straight month. The economy is softening, affordability is at rock bottom, and yet home prices won't go down. And that combination isn't stability, that's pressure. And understanding that pressure today will help you understand where the next break happens long before anyone else starts even talking about it. Because the truth the headlines never explain is surprisingly simple. Foreclosures aren't low because people are fine. Foreclosures are low because nobody can afford to sell. And that rate lock era created a market where millions of homeowners would financially drown if they moved. Now, when someone has a 2.8% mortgage, they don't list their home unless life leaves them no choice. That's not a healthy market. That's stasis, holding everything in place like a photograph that looks peaceful until you notice the strain frozen in the edges. Now, foreclosures rising 20% sounds dramatic until you zoom out and see the baseline was unusually low. It's like spotting a crowd in the desert and assuming the desert is full. The change is real, don't get me wrong, but the landscape hasn't exactly transformed. The danger isn't the number, the danger is the direction of the trend and the fragility behind it. People say foreclosures are low because mortgage rates are low. And that's true, but it leaves out the part that matters though. Low rates don't make life affordable. They just trap people. Because when 72% of mortgage holders sit under 5%, the lock-in effect becomes a financial anchor. It holds people in place even when work shifts, bills rise, or insurance suddenly doubles. It feels safe the way a bridge feels safe when you're standing on it, even if you can't feel a faint vibration. Underneath tells you that something isn't quite right. And the real pressure isn't showing up in default numbers. It's showing up in liquidity. Buyers can't afford to buy, and sellers can't afford to sell. So investors can't cover mortgages. Builders can't move homes without incentives. A frozen market always feels orderly from the outside, the same way a lake looks calm on the surface, even though the current below is pulling in a completely different direction. Now, shadow supply is a big part of that current. It's the inventory people don't see yet. STR conversions dropping off platforms, investors quietly selling the worst performers, and landlords exiting after multiple non-paying tenants. And families, they're staying afloat with HELOCs. Condo buildings are strained under new repair requirements, and homeowners are staring down insurance renewals that feel like another mortgage payment. None of this shows up in the headline numbers, but it is shaping behavior long before it shows up in the actual data. Now, if you want to see the future, you look at the places that are breaking first, and Florida is one of them. Insurance premiums are spiking, condo reserve laws hitting older buildings like a financial hammer, and investors are exiting. Boom era buyers are under pressure. Now, hurricanes are rewriting entire zip code risk profiles. When one part of the country bends this early, it's rarely an isolated story. Now, meanwhile, the Midwest and the Northeast, they look almost bored by comparison, appreciating steadily as if they're in a different economy altogether. But here's the thing, like, when a market moves in opposite directions at the same time, that's not equilibrium. That's redistribution of stress. A lot of people cling to home equity as their safety. And homeowners have equity, so they feel fine. But equity is helping people survive, but not in the way that you think or the way that it should. It's acting like a pressure valve. Most people are pulling from their homes just to keep everyday life running. HELOC withdrawals are rising. Credit card balances are increasing. Savings are thinning. It's the kind of stability that looks solid until you tap it. The way drywall looks smooth until you press your thumb against a spot, and then suddenly it sinks in way too easily. And that brings us to the part nobody spells out clearly. The reason foreclosures are low is the same reason market pressure is rising. Rate lock-in doesn't protect the market, it freezes it. Frozen supply props up prices. Higher prices create paper equity. Paper equity delays distress, and delayed distress becomes quiet risk. And quiet risk becomes the thing that reshapes the market, not with a dramatic blowout, but with a slow grinding pressure that doesn't make noise until it's too late. Now, the 2025 housing market isn't a bubble bursting or a boom accelerating. It's something much more subtle. It's a rubber band stretched too tight, held in place by rate locks and low inventory, thinning quietly from the inside. Now, markets rarely break with fireworks. Most break the way tired shoelaces might snap, not because someone pulled hard, but because it had been wearing down for so long. So what does this mean for us? If you're thinking about buying, remember that high price doesn't mean the market is strong. It might just mean the pressure hasn't reached your area quite yet. And if you're thinking about selling, watch your local pressure points. Insurance renewals, inventory rises, investor retreat, builder discounting. Some markets are already bending. Others are riding momentum that isn't sustainable. So if you're holding, keep an eye on the real risk indicators. Insurance costs, HOA stability, local job markets, not just your home's value. Values move last, pressure moves first, which leads to so many more questions about the future. All right, guys, do I have this all right? Do I have it all wrong? Please put it in the comment section below. I look forward to reading and replying to all of your guys' comments. And thank you guys again so much for watching me here on The Baseline. Okay, cheers, everybody.